Most of us think of the traditional mortgage when buying a home. You either go to a mortgage lender or to a bank. We should know there are alternative sources to financing a home purchase. One of them is seller finance. Our topic for today is buying a home with seller finance. Not everybody will qualify for a traditional mortgage. What is seller finance? An agreement between you and the seller or the owner of the house. The seller extends credit to the buyer. Therefore, the seller becomes the bank. The seller becomes the mortgage lender. In a seller finance deal, there are two key considerations. Number one is the agreement. In other words, the contract. I, the seller, is selling a property to you, the buyer, on X terms for X amount of years for X money. Second item is the promissory note. The buyer promises to pay X amount to the seller for a considerable number of years. The seller would have to transfer title of the property to the buyer after the buyer completes the promissory note agreement. Seller finance is very common in downtime. What I mean by downtime? I mean when this is the buyer's market. A buyer's market is a situation where there are too many houses and not enough buyers. Maybe due to the fact that lenders are not willing to lend out money to buyers. Seller financing becomes an alternative, providing you the opportunity to still be able to own a home. So the fact that you do not qualify for a traditional mortgage should not bar you from buying a home. I have seen situations where a buyer cannot qualify for the loan, then they walk away. You should be able to ask the seller if they will be able to do a seller financing for you for a couple of years. So whenever your situation changes, you build credit. Whenever your income changes, you can be able to buy that home. How do we structure a typical seller financing agreement? The buyer signs a promissory note. In that promissory note, it will state the interest rate. It will state the repayment schedule. It will also state the consequences in case you default. Seller financing agreements are always short term, maybe 3 to 5 years. A seller finance agreement is always structured with a balloon payment at the end of the term of that agreement. So let's say, for example, you do it for 5 years. At the end of 5 years, you're supposed to be able to qualify for a traditional mortgage, so you pay off the seller. So to start with, you can tell the seller, I can give you X amount of money as a down payment. And then we go into an agreement where I assume your mortgage. From today moving forward, I take over, I am responsible for your mortgage payment. I will be sending the payments to the bank directly, because the banks don't care who makes the payment. All the bank want to know is that the payments are being made. Because if you make the mistake of sending those payments to the seller, how are you sure the seller will be paying the mortgage company or the bank? You give the seller some money up front, then you assume their mortgage. You make direct payments to the mortgage company on a fixed interest rate. So within 5 years, when the balloon payment is due, what is balloon? Balloon means on the 5th year, you're supposed to pay off the seller. So what happens in the 5th year? You're supposed to qualify now for a traditional mortgage. You get a traditional loan, and then that loan pays off the seller. But the good thing is, within this time, you are still building equity in the house because you own the house. The owner keeps the title of the house, but you're making the payment. When you pay off, when the balloon is due, when you pay off the seller releases the title. The first due diligence, the first thing you want to do, always involve a qualified attorney. I mean an attorney who knows how to structure seller financing agreements. The attorney will do a title search. A title search is very important because if the seller has not paid off that home, then it's very risky. I advise you not to get into any seller financing agreement with the seller. In the mortgage world, we say the seller has paid off the home, so he owns the house free and clear. The attorney will help you to determine that he owns the house free and clear. The attorney will also make sure the house has no liens, no tax liens, no homeowner association liens, no mortgage liens. Because if there are any liens and you buy that property, you automatically inherit those liens. The biggest due diligence in a seller finance agreement, when you get a traditional mortgage, it has what we call a due on sale clause. What does due on sale clause mean? It means if you are to sell that house to somebody else, the mortgage company will automatically demand that you pay them in full. The due on sale clause is very important, and that is why it is important for your attorney to determine that you have paid off that home, that you own that home free and clear. Because if you don't own it free and clear, and you are doing a seller financing agreement, when the mortgage company realize you have sold that house to somebody else, they will now inject this due on sale clause, and you have to pay the entire amount of the house. And you, the buyer who's entering into an agreement with the seller, you lose your upfront money that you pay the seller, your down payment, and you lose all the money that has gone into that property. You are doing a home contract. It is always very important to ask for a certified appraisal from the owner or the seller. If you don't have an appraiser, how can you determine the value that is being agreed upon in the contract? You need an appraisal. You are buying a home. Also do inspection. Although the seller may not agree to fix the items in the house, sometimes you may come to an agreement with the seller where you do a 50-50 deal. All the repairs cost $1,000, upfront $500, the seller will front $500, and we take care of the repairs. When you get into that home, you are responsible for all the repairs. The seller don't consider that home as his anymore. He considers that home as yours. So your due diligence is very, very important. Seller financing, if structured correctly, is a huge untapped market, both for investors and for home buyers. Never shy away from owning a home just because you cannot get a traditional mortgage. Always ask the seller, if they'll be ready to do an owner finance. Most of the time, if the seller has paid off the mortgage, they will be willing to do a seller finance. Once you sell one property, you as an investor, you have to pay capital gains tax on it. But if you give it on an agreement like this, then you defer that capital gains tax. At the end of the 3 years or 5 years period, when the buyer now qualifies to get a mortgage, then it becomes their primary residence, and that capital gains tax is still very minimal for you, the investor. So always ask your real estate agent. Whether you gain or lose in a seller finance agreement depends on how you do your due diligence, depends on how you structure it. In a downturn economy, seller financing could be a huge opportunity, especially when banks and mortgage lenders are not willing to release cash to the public. We find ourselves now in one of the most unprecedented of times with the coronavirus pandemic. I am sure once the eviction moratorium, once the forbearance will expire, we will see a backlog of mortgages and a gazillion evictions. And I truly think seller financing will become handy. What are the advantages for a buyer? Number one, it is an alternative to traditional mortgage financing. Good for buyers with a high debt-to-income ratio. We all know in the traditional mortgage world, if your debt-to-income ratio is high, you may not qualify for a mortgage. But it's not the case when you have to make an agreement with the seller for the purchase of their property. There's a flexible amount of down payment. In a traditional mortgage, we have 3.5%, 5%, 10%, 20%. In a seller financing, you get to negotiate the down payment with the seller. So it's flexible. It is much faster. You don't have to wait for 30 days, 45 days. Seller financing deals are completed within days, a maximum of 1 week. I've seen some of them being done in 1 day. It gives you, the buyer, an opportunity to also build equity. As you're making the mortgage payments to the mortgage company, you're also building some equity. There are no costs for mortgage discount points. In a traditional mortgage, you have the option to buy discount points in order to reduce your interest rate. We don't have that in a seller financing because it's between you and the seller. It gives you and your family the comfort of home ownership. There are few or no closing costs. The only cost sometimes would be the little attorney fee, and it is always negotiable. For a buyer, it is a very lucrative alternative to home ownership. Are the disadvantages of a seller finance deal to the buyer? Higher interest rates, because the seller is taking what? The seller is taking risk, so that they will charge you more interest. Also pay fees for the title search. And sometimes you may have to pay fees for the survey. You may also lose money if at the end of the balloon, when the entire payment is due to the seller and you are not able to qualify for a traditional mortgage, what happens? You lose both the down payment you gave to the seller. You also lose the money you've been making monthly payments to the mortgage company. You also lose whatever fee you may have paid to the attorney for drawing up the agreement and the promissory note. You also lose the money you paid for maybe an appraisal or an inspection. A high interest rate may wipe out the equity you build over time. You have to be very careful when you structure a seller finance deal. Make sure your down payment is always very minimal. Make sure when you amortize it, you amortize over 30 years period. So your monthly payments is small, and investors love when they amortize over 30 years because you can turn around and put a tenant in that house, and that's how you get positive cash flow. It could come to a situation where you are not able to qualify for a traditional mortgage when the balloon is due to pay off the owner. So at that point, you'll be able to minimize your losses. Seller financing is a huge opportunity for the seller, especially for people who are looking to get into real estate investing. What are some of the advantages? It is quick and cheaper than conventional loans. It is faster because there are no underwriting fees, there are no title company fees. Seller pays no commissions, zero commission, an agreement between you and the seller. It defers capital gains tax, especially for investors. Seller may sell the promissory note to an investor for a lump sum fee. That's where they make more money on a seller financing deal. They make money also from the down payment that you, the buyer, will make to the seller. They can sell the house without making any repairs. Because the seller is taking a risk, what they do, they charge you a high interest rate for that risk. So therefore, they make more money on the high interest rate. If the buyer defaults, the seller gets to keep the down payment, all the money you've been paying to the mortgage company, they keep it. This is a huge opportunity for the seller. It also presents a huge opportunity for you, the buyer. But you must make sure you do your due diligence. There exist non-traditional ways of buying a home, and we must be able to exploit all of them depending on our circumstance. C2C is a real estate mentorship community. Here we talk about your finances, we talk about real estate. We understand it is at the foundation for your success and for your family success. Thank you so much. If you have already subscribed to our channel, we appreciate all the great comments. This is a community for all of us to learn, and see you on our next video.